When it comes to buying a car, one of the biggest topics of conversation is whether or not you should buy in cash, lease, or finance a new car. Now, the reason that this topic is so important is because a car is the #1 most expensive thing that you'll ever buy that will for sure go down in value. That's actually what makes it different than a house, which could be the most expensive thing that you buy in general, but a house can potentially go up in value, whereas a car, at least for the average person, is guaranteed to go down in value pretty much as soon as you drive it off the lot. And I'm sure a lot of us have heard the different talking points across the spectrum of the car buying scale. On one hand, we have people saying that cash is king. On the other hand, we have people saying that financing is the only way to go these days. And on the third hand, we have people saying that leasing is the only way to go if you want to drive a new car every few years and not have to deal with any car-related issues. Well, clearly we have a lot to talk about today. Overall, making a decision about how you're going to go about paying for a vehicle will impact a number of things, including the overall cost of ownership, the feeling of ownership, how you'll handle things like maintenance, and how depreciation plays a factor. We've actually seen the cost of cars, and used cars in particular, go up over the past 5 years or so, and we've also seen the cost of leasing and financing go up as well. So in today's video, we'll break down all three of these options: buying, leasing, and financing, and hopefully shed light on what makes sense for the average person.
So now let's set the stage here. So according to an article that compared car payments between Canada and the US, we actually see very similar numbers across the border. Apparently about 80% of new cars are being financed either through a loan or a lease. And even though it's less in the used car market, 38% are still being financed, which is still huge. So what does that mean? It means that there are a lot of people who are opting to finance their cars either through a loan or a lease. Basically, there are a lot of people who are making car payments each and every single month. Now, these costs can definitely vary, especially depending on your credit history, interest rates on car loans, and the type of car that you're looking to purchase. But the average monthly payment on a new car is currently sitting at $745 a month, and the average monthly payment on a used car is sitting at $521 a month. And keep in mind that these numbers are higher in Canada. Now let's make sure that we're all on the same page with these different terms. So when we say buying a car in cash, that usually refers to someone who has saved up the full amount required to purchase the car outright. This means that as soon as the transaction is complete, they'll own the car. Paying in cash can mean actual physical cash, it can mean a wire transfer from your bank, it can mean a personal check, and it can also mean a cashier's check as well. Financing a car typically refers to when someone makes a down payment on a car and then borrows money, which could be from the dealership itself or from a bank, in order to make the purchase. Then, over time, they'll pay back the loan plus interest. So instead of paying the full cost for the car up front, instead they'll make regular payments, usually monthly, until the loan is paid off, and at which point they'll finally own the car outright. Leasing a car is basically a long-term rental agreement, which is a very important distinction. In this case, you pay to use the vehicle for a specific period of time without ever owning it. What's interesting about a lease is that at the end of the leasing period, so when the agreement is up, you're expected to either give the car back, extend your leasing period, or take on a new lease, or purchase the car for its residual value, which is a pre-calculated amount of how much the car is going to be worth at the end of that leasing term. Now, assuming all things are equal, traditionally, people who have the ability to are often enticed to lease a car due to the possibility of having lower monthly payments. But here's the thing, even if the monthly payments are lower, does the overall cost of ownership stay low too? Well, let's really kick things off by diving into leasing a car.
So let's get right into it. Picture yourself walking into a dealership, all excited about getting a new car. You sit down and you ultimately opt to sign a lease on a brand new Toyota Corolla. Well, the first thing that's important to understand is that you're not actually renting a car, despite what we said earlier about leasing. Before, we basically went over the high level or more common way to explain it, but here's how it really works. When you sign a lease agreement, what you're actually doing is renting money, so a loan. And it's not free, by the way. The value of the loan represents how much of the car that you'll use and bring down in value from you driving the car. Now, given that you're not paying to own the car, what you're paying for instead is the cost of the money that they're lending to you. Now, that's the value of the car minus what they expect the car to be worth at the end of the lease term. It's basically the drop in value that the car will experience during your lease term, aka depreciation, plus some other fees and taxes. So now that we have that understanding, let's actually break down what goes into the calculation of your monthly lease payment. The biggest component of the payment is what we just covered, depreciation. This is you paying for the difference between the sale price and what they predict that the car will be worth at the end of your lease term, aka the residual value. For example, if you lease a $30,000 car for 36 months and its residual value at the end of that term is $10,000, then you're paying for that $20,000 of depreciation that the car experienced during that period of time. The next component of your lease payment is the finance charge. This amount represents the interest that you're paying in order to use the leasing company's money. Another component that you can't forget about is taxes. In many places, you'll see sales taxes being charged on the monthly lease payment, and there's no question here, taxes must be paid. And the last component is fees and any add-ons. Now, this could include extended warranties, gap insurance if it's included, a fee for the actual leasing paperwork itself, and then just a ton of other ridiculous fees that would probably surprise you if you ended up coming across them.
So now that we've covered leasing, let's get into financing a car. Typically, the way that the process works is that you'd ideally talk to your car dealer and come to an agreement on the sales price, and then you'd figure out which financial institution that you're gonna use in order to actually get approved for a loan. That way you can purchase the particular car in question. Now, this may or may not come as a surprise to some of you, but dealerships are no longer in the business of just pushing cars anymore. In fact, their biggest moneymaker is often the loans and financing part of their business. So what that translates to us, the customers, should be an understanding that car dealerships give their salespeople an incentive to earn commissions and potentially make higher profits from arranging loans rather than just selling the cars themselves. And if you think about it, with this model, they're also keeping you within their ecosystem longer, which gives them the ability to make more money from add-on products and services and from even financing the deal itself. Now, the way that the numbers work when you're financing a car is that you'll typically have the opportunity to put some money down on the car, and then you'll borrow the rest of the money in order to cover the agreed upon sales price of the car. Now, loan terms can vary depending on the individual, but it's important to note that if you're thinking from a monthly payment perspective, specifically how you can bring down your payment by as much as possible, then your loan term could end up being longer than it needs to be. The average loan term is actually 68 months or 5.6 years. Now, when it comes to the interest rate on the loan, this can also vary depending on both your personal financial situation, so your credit history and your credit score, and the economic climate at that particular point in time. So if you're hearing that interest rates are high in the news, then you should know that this also affects car loans, including the one that you're potentially about to get.
Okay, so now that we've covered the basics of both leasing and financing through a loan, let's get into some real-life examples to see which option makes the most sense given a variety of different scenarios. We're also going to include the option of buying a car outright so you can see how that plays out as well. So to kick things off, let's take a look at the Toyota Corolla L. This to us is a pretty standard sedan from a brand that many people trust, and it's also one of the base models from Toyota, so it's not too expensive, although it is brand new. Now, to keep things simple, here's the breakdown. The MSRP, or the suggested retail price on this car, is $26,925. Let's say that we want to lease it for 36 months, so aka 3 years, which is a very common leasing period, and we're going to put $0 down on the car in order to keep the math really simple. So the term will be for 36 months, and you'll have 24,000 kilometers a year, which would be the max amount that you can drive. And by the way, this seems to be the standard option at Toyota. You can always choose a lower kilometer option if you want to, or you could also decide to purchase more kilometers during your lease at an additional cost. Now, by the end of the lease, you'll be able to buy this car from the dealership for a residual value of $16,694. So what this means is that the depreciation portion will cost you $284 a month. That's the MSRP minus the residual value divided by the lease term. And if we assume a 5% interest rate on this lease, based on where interest rates are at right now, then our finance charge will be about $91 a month. That brings us to a total of $375 a month pre-tax. And that's also not including any other fees or add-ons that might come with the lease. So after 36 months, you'll have spent $13,500 to lease the car. Now, if you choose to buy the vehicle for the residual value of $16,694, then you'll have spent $30,194 in order to fully own the car. And keep in mind that this doesn't include the cost of operating the vehicle, so things like gas, insurance, all of those costs.
Now let's move on to a financing example. So for the sake of keeping things as similar to the leasing example as possible, in this case, we're not gonna put any money down on the Toyota. Instead, we're gonna keep the down payment at $0 and keep the interest rate at 5%. In a real life scenario, you would have the opportunity to put some money down, which could bring down your monthly payment. And if you have a great credit score, it could also bring down your rate, and you'd have the opportunity to negotiate the suggested sales price. Anyways, as a reminder, the Toyota Corolla L has a sales price of $26,925. And let's assume that we're going to finance the vehicle for 36 months, aka 3 years. Which, by the way, falls within the 23/8 rule, which we discussed in our last video. This means that our loan payment will be $805 a month after using a standard loan payment formula. And by the end of those 36 months, you'll have paid just under $29,000 in order to own the vehicle outright. And similar to the lease, this doesn't factor the cost of actually operating the vehicle during that time. Now, I know that some of you are looking at this example and thinking there is absolutely no way that someone is paying $805 a month to finance a Corolla for 3 years. And my response to that is that there is definitely someone somewhere who's doing that, probably for more years because they're probably already underwater on, other cars. But to make it a bit more realistic, if you were to add a 20% down payment in either example, so the leasing or the financing one, it would dramatically change the numbers. In terms of financing, if you were to put 20% down, so just over $5,000, this would actually drop your payment to $644 a month. And that's still high, but the more money you put down plus a lower interest rate, then the lower your payment is gonna be and the less amount of money you'll pay in interest over time.
Now let's wrap this up by talking about if you decided to purchase the car outright from the get-go. In that case, you would have paid a total of $26,925, which is the sale price. So let's do a side-by-side comparison here. For a 3-year lease, you would have paid $13,500. And had you decided to buy the car at the end of that lease term, then your total cost of ownership would have been $30,194. If you had financed the vehicle with a 3-year loan, then your cost of ownership would have been $28,997. If you had purchased the car outright from the get-go, then your total cost of ownership would be the MSRP of $26,925 or whatever sale price you ended up negotiating. So from our examples here, you can see that leasing definitely costs more. And I'm sure there's going to be people who are attempting to explain that that isn't always the case. But generally speaking, leasing does typically cost more, primarily driven by the finance charge and the other leasing fees that you wouldn't otherwise have.
The other thing that we want to talk about when it comes to leasing is that you'll often hear people say that it affords them the freedom to drive without commitment. Basically, you'll have your car for a few years until you get your next upgrade. And you'll also hear people say that it's not renting because you have the ability to buy the car at the end of the lease term if you want to. On top of that, routine maintenance is included. You never have to go through the hassle of selling your car. And probably the biggest one that you'll see online is that you're able to get tax deductions on a lease if it's under your business. So there's a lot to unpack here. First and foremost, when you're leasing a car, you're paying for that car's most expensive years of its life. This is because significant depreciation happens at the beginning and dealers love that. And you know why? Because they usually get the car back and they can sell it as a certified pre-owned vehicle before any major maintenance issues come up. And another thing that's not as talked about is that you're obligated to return the car in the exact same condition that you got it. So if you made upgrades, great, no one cares. Get rid of them. And if there's damage to the vehicle, you have to fix it. Now, on top of that, kilometers or miles is another big one because there's a cap on how much you can actually drive the car. I guess if you know that you don't drive a lot, then this probably won't affect you as much, but in the event that you do want to take like a major impromptu road trip, you have to keep in mind that if you go over your allowable limit, you'll have to pay more money. And if you're under your allowable limit, then you don't get any money back. Now, when it comes to the tax deductions or tax treatment that you would receive if you were to purchase the vehicle for commercial use under your company, yes, there can be benefits to this, but overall, this does not apply to the vast majority of people. Also, if we're talking purely mathematically and your goal is to simply minimize the total cost of your car purchase, so not factoring in how the tax benefits might benefit your cash flow or other areas of your business as a result of this, buying a vehicle outright instead of leasing is usually cheaper than leasing. I mean, think about it. You don't have the leasing fees and finance charges, let alone any other add-ons. The reality is that you shouldn't let online business influencers who swap out luxury vehicles left and right and are likely just stating what their account has told them without an explanation as to why influence your personal car buying decision. So, who is leasing right for? It's right for someone in very specific business use cases, anyone who doesn't care about paying more money as long as they don't have to worry about things like maintenance costs, and they also get a new car every few years, or someone who doesn't put a ton of driving into their cars on a yearly basis. And once again, the key here is that they don't care about spending more money. So it's not for the average person, at least the majority of the time.
Overall, the most ideal way to purchase a car for the vast majority of people is to buy used and pay for it outright. Now, if this isn't a reality for you at the moment, then following the 23/8 rule can be very effective, and it also limits the amount of interest that you're going to pay over time. Now, we also do want to mention that because of changes in the industry, you might come across a situation where your salesperson's actually more incentivized to give you a better deal if you finance the car as opposed to paying for it in cash. We've actually seen this firsthand with friends where they're offered discounts if they take on a loan through the dealership's financing arm. Now, if you do decide to do this, make sure that it makes sense and is actually worth it financially. And then even more important than that, make sure that you're disciplined to only keep the loan open for the minimum amount of time that's actually needed. And then as soon as you can, pay off the rest of it completely. Often at times, the salesperson only needs to have the loan open for a couple of months in order to get their commission. With all of that being said, we hope that you guys enjoyed this video. If you have any questions or thoughts, let us know down in the comments below. Also, we really want to know if you're someone who typically leases or finances or buys your cars outright. So let us know that down in the comments too, and we'll see you next week with another video.